Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for November 2nd, 2020. Please see a disclaimer for important information. Here's our COVID tracker for the week, showing 7-day moving averages for both new cases as well as daily deaths. We continue to see an uptick in new daily tests, positive tests, and we've seen a little bit of an uptick here in October on daily deaths as well, from a kind of an interim trough that we saw kind of at the beginning of October. Not terribly pronounced, but and certainly disproportionate to the rise in the number of positive cases. Now, we do know that there's a lot more testing going on, but clearly something that I think a lot of people have been paying attention to lately. And as we'll see, this is not just a U.S. trend as well. In fact, here is confirmed cases, looking at it from a different way. Now, this is also from the COVID tracking project, which is where the data in the previous shot comes from. But you can see that we're up to 88,000 as of the end of last week. And you can see a very definitive rise, and I guess what we'll call almost like a third wave that dovetails on what we saw earlier in the spring and then again in July. This is the case fatality rate, and I want to make sure that we get this out there. So, what you saw in that first chart was a 7-day moving average, and so this is basically taking a case fatality, calculating a case fatality rate using weekly deaths divided by positive cases that were 2 weeks prior. So you can see that in some cases people are getting retested, and that's counting as an additional test or maybe even an additional positive. But overall, the rate of death, certainly as you look back from April, has gone down and kind of held at a fairly consistent rate, even through that surge during July and again during the current surge. Now, again, with this calculation taking into effect the lag effect of infection rates transitioning into the illnesses or potential death, it does a pretty good job of capturing what would be the case. Obviously, I think we would certainly be more concerned if we saw these things bump significantly during those second and third waves. But obviously, this is something that we're going to continue to watch. But at least from a fatality rate standpoint, the virus has not manifested into a lot more of that. This is something also from the First Trust package that I saw for the first time last week, and I didn't post it, but I thought I'd include it here just to give us some context with this latest rise in cases here in the U.S. So this is a chart going back to 1900, basically, on monthly deaths per 1 million people. And this is from all sources. And as you can see in the labels on the chart as you go through, and much has been made of the 1918 Spanish flu and how the economy and how people managed through that. And that was, certainly not a snapshot in time. If you were living through it, then it was a very, very serious deal. And you could see that the fatality rate was phenomenal during that point. And then the Spanish flu and the second wave, which was 2 years after, and then you see the other pandemics there. And the COVID-19 does represent an uptick over what we've seen, and it's not to be discounted. However, I think putting it into context, when you've seen other pandemics, it's not that dissimilar if you take out the basically the 1929 and the Spanish flu, which persisted for a couple of years. This is what I was referring to a couple of slides ago. This is the rise in cases in Europe as well. We have a Canada label in here as well. You can see the UK, which arguably is still kind of Europe, even though it's not on the continent. But and just this week, you've heard Prime Minister Boris Johnson announce lockdowns and things in the UK. And France has a real big problem right now, and you can see in terms of new case volume, and it's in areas like Germany that have had fairly good statistical um, success in trying to manage the pandemic. Even there, we're seeing a meaningful rise in case volume. As a result, this is the impact that's expected on these various economies, not just the European continent, but this is globally. In fact, it's less Europe than it is rest of the world, but you can see the tremendous impact that the pandemic has had on these other economies. And you can see France and UK very well represented. Italy contracting by more than 10% here, but again, it's not endemic to those areas as well. I think the US at perhaps a 4+% decline anticipated in 2020 GDP, or basically a 4.4% contraction in our entire economy, really does pale in comparison with some of the other third world and even some of the developed world nations. And as you can see in the blue, China is really the only major power, if you will, even though they're not perhaps a developed economy in the strictest sense, but they're the only ones that are expected to grow this year. This is our weekly high frequency data chart. As you can see, the data continues to be mostly positive, and particularly over the last month. This is something that we were, a little bit concerned about several weeks ago, as we saw a little bit of retrenchment in TSA checkpoint data, and that continues to be very good, even though last week was down slightly. But restaurants were perhaps flat at best, but at least they're not declining. That's good. The hospitality sector is doing okay. And we've got some other charts to show you that I think will kind of help to emphasize some of these data points. But steel production, some of the heavy industries, continue to see good data there. Rail car traffic, box office receipts still very, very low relative to a year ago, but again, showing a little bit of strength there. And as you look across the spectrum, really not bad, all told, this week and actually this past month. This is the chart. This is a chart rather that shows you a couple of those items. TSA checkpoint data, airline passengers, as well as open table restaurant numbers, which shows people going out to restaurants. And you can see, even though the airline passenger numbers are a little bit lagged, you can see that they're going up a little bit, and that's good. Also, the open table restaurant numbers year over year have rolled over ever so slightly, but the numbers are on balance not terribly negative. This is year over year, and you can see on the y-axis there that the negative rate of growth is still really, really significant. But if you kind of draw a line from, say, the beginning of August to where we are here in October, the trend line is certainly positive. This is trucking data, and you can see in the black line, it actually includes car travel or passenger traffic in cars as well. But both cars and trucks are looking better than they have been. Again, we still have room to go, but on balance, this information is encouraging, even though it's not exactly where we would like to be, but indicative of a positive trend. This is a snapshot of GDP, and I thought this was great from Access that showed us the path that we were on And this is a fairly linear path. I mean, if you assume that we're going to grow anywhere between 2 and 4% on an annualized basis, that trend is easy to map out as you head into the next 4 years. And you can see the massive deviation that we took and the destruction in the economy that the pandemic and the ensuing shutdowns caused. Now we've battled back, and we know that that our economy, at least in the first reading of third quarter GDP, was up on an annualized basis, 33.1%. That's a big number. That's annualized. But again, that's recapturing some of what we lost in that massive second quarter drop. And it's just the law of numbers that it takes a much bigger number on the upside to offset what you lose on the downside in percentage terms. And so we still have a ways to go. You can still see that we're well below trend line. And again, this kind of helps to emphasize a little bit the fact that it's going to take a while for us to get back to where we need to be. And this is kind of a quick snapshot. I would just encourage you to focus your energy on the right-hand side of this chart, which shows you the visceral reaction to the pandemic and the shutdowns. And so we were negative in the first quarter because of the initial impact and some of the initial shutdowns in March. Second quarter was feeling the full brunt of that downturn. And then the third quarter, obviously, we bounced back. And as I said, we were up slightly more than 33% on an annualized basis. But it's the devil is always in the details. And what I think is really telling in here is that as much as consumer spending dropped in that gray section in the second quarter, it really rebounded in the third quarter. Now, this is the sustainability part. We need to continue to see that because consumers represent 2/3 of our economy. And so it's extremely important that we have follow through on these numbers. The other positive element, actually two positive takeaways here, is that we had net benefit from business investment, which is also very important. We know that CEOs are on balance a little bit more optimistic than consumers are, and so they're putting their money where their mouth is, so to speak. And then we also had inventory build, and it's across a lot of different inventories. But I think the positive takeaway here is that inventory growth is important to our economy. We know that a lot of stocks are low, so they're being replenished, and that's good news for our economy. And the last thing on this slide that we've talked about numerous times is the strength within the housing sector. And so housing has been a net positive here for the third quarter. Again, these four key areas are things that we want to make sure, or that we hope certainly continue to be a tailwind for fourth quarter growth. A little comment on consumer spending, and then we're going to get into a little bit of holiday shopping kind of analysis, some interesting data there. Now, and I've showed this chart before several weeks ago, but again, you can see that good spending by consumers has really rebounded. Now we've talked about the COVID purchases that you are making, washing machines and new grills and things like that. And I'll raise my hand and admit that I've been a little bit a part of that. But you can see down below, and this is where it's impacting a lot of small businesses, is that services spending is still significantly below. Even though we battled back, we're still significantly below where we were in the first quarter. And this is really the kind of the crux of the issue for small business right here. As long as that number remains negative, we're going to have some contraction in overall small business activity and have small businesses frankly struggle a bit in the weeks and the months ahead. Trade is another issue. Now, trade typically has a net contribution to growth. What's interesting in this chart, and the reason I put it in, is that net exports have been a positive influence on GDP growth for the last several quarters, and this time it wasn't. Now we had basically a negative influence from imports, even though our exports went up, which is positive, which is a bit of a reversal from what we saw last quarter. But imports accelerated as well, partly due to the strong consumer spending that we saw. So, in our trade contribution to GDP is essentially net exports minus net imports. And so with imports being very strong due to consumer spending, that was a negative influence on GDP this quarter. Now we've got a couple of slides related to holiday spending, and it actually leads to different conclusions. And so, the big bugaboo heading into the holiday shopping season, which I would argue, on beginning of November, we're already there. So, what is that going to look like? I think that's interesting for us to study. Now, in this chart, this is a Gallup survey, and this is like an average dollar amount. So you can see that, what it's implying is that we're back to like 2015 levels. This is just a survey. Again, this is what people think, not necessarily what they do. And sometimes those numbers look a little bit different when you do the final analysis, but clearly there's an expectation from the Gallup survey that spending is going to be less by a meaningful amount. And if you just take, basically 9.5, basically what, 1.5 off 9.5. So, that's basically about, somewhere between 10 and 15% if you want to use really, really rough math. But that's about what we're looking at here. Now, this data is from Visa, and it actually paints a little bit of a different story. So this is a survey that they do, and this is perhaps less of a survey of individuals than it is kind of an analysis of people that are doing the analysis on the data that they've seen thus far, and they're expecting actually a pickup. And what's interesting is that when you look at the age cohort, which is on the bottom, now the net spending growth is expected by their yardstick to be up almost 8%, which would be terrific if it happened. And down below, you can see what's interesting is the demographic breakdown of all that. So you tend to see over 55 basically indicating that they're going to be spending the same, if not more. This is just a graphic that shows you, fairly intuitive to all of us, that there's going to be more online spending this year than what we've seen in the past. This is something that I thought was really interesting, and it's a little bit of a busy chart, but let me just distill this. So you've got data from 2014, and you've got expected data that for 2020 for holiday spending. And I put stars next to the areas that are really showing kind of a deviation, if you will, at least one that makes sense to me. And that's on the left-hand side of these charts. So if you look at 2020, what the survey is telling you is that you're going to have more spending at small businesses and locally owned stores and boutiques than you will at the department stores and specialty stores like Gap or Best Buy. And both of those categories are expected to go down if you look at it, 6 years ago to today, which, from my perspective is really good news, because that means that there's at least a little bit more of an interest in taking money out of the large box retailers and putting it in the hands of small business. We'll talk about inflation briefly. We have been discussing it for quite a bit over the summer as we saw the inflation expectations meander back up following the shutdowns. And August, they kind of reached their apex, and now they've kind of tempered out a little bit. We haven't really seen a lot of action in inflation expectations, and even in the consumer confidence, consumer sentiment numbers that also measure inflation expectations, it's really been somewhat muted as of late. Now, the one area that I think deserves some attention briefly is housing. And we know the housing sector has been really, really strong. And this is a chart from the St. Louis Federal Reserve database and reprinted by the Daily Shot here that shows in blue the house price index for the U.S. And this is a long time series, so it goes back to well before the beginning of the new century here, and it tracks it well before the pandemic. You can see that housing prices continue to accelerate and actually exceed hourly earnings. So what is this telling us? This is saying that housing inflation is far outpacing average hourly earnings and creating less affordability overall for would-be home buyers. A couple of comments on unemployment and employment and labor in general. This is good news. We saw leveling out in initial claims around the 800,000 level. Latest data point was a little bit lower. Positive read-through. We do have PUA or pandemic assistance claims. The overall trends are down. We're still well above where we were pre-pandemic. So on balance, even though labor seems to have kind of stalled out a little bit, this number is on balance positive. But as we'll see in the next chart, there are some definite issues that we need to pay attention to. Now this is showing the continuing claims, and I've been talking about continuing claims continuing to come down, which is good. And the regular benefits are depicted here in blue. And you can see that trend line coming down from April. That's really, really positive. Now you see overall continuing claims go down as well, but the red and the orange or yellowish up above that are both related to specific programs that are tied to pandemic assistance. And these benefits will drop off at the end of the year. So what that tells you is that you've got 60% of the total continuing claims, which is highlighted in that piece below, or 14 million individuals that were receiving these types of benefits. Those benefits are going to go away at the end of this year. And so you're going to have a lot of folks that are not only going to have less income, but then you're also going to be at a sticky point with regard to those who happen to also be renters, where some of these forbearance provisions also expire. And that means that, not only are people going to have less money, but then a lot of these folks are going to be forced out of, they're going to be evicted for non-payment or debts in arrears on their rented real estate. This is something else that I've talked about in quite some detail, and I won't spend much time here, but it just shows you the huge dislocation with regard to state and local employment. That we know that tax receipts are going to be lower. We know that that there are going to be some municipalities that are going to be challenged, and in response to that, you can see that on the left-hand side, state and local government hiring is down, even though it's picked back up slightly. But on the right-hand side is just state level employees, and you can see that those numbers are way down. Business formations. I came across this chart and I had to do a double take, but the read-through on this is fairly interesting. So you have a lot of people that have been displaced, that have been laid off or furloughed, and they're at home starting businesses. They're forming LLCs and other types of businesses. And so we've actually had a really strong spike in business formations, but most of these are basically solopreneurs that are either branching out on their own because they're being forced to, because they're laid off or furloughed, or they're people that were already working from home that are starting second businesses. We'll talk about the stock market briefly. 3,400 and the S&P 500 is a fairly important level. And with the action last week, and I know that we've enjoyed a fair amount of upside appreciation, as you can see in the middle of that chart, through most of the summer. We've seen more volatility. Obviously, September was a challenging month. October started off well, but then we kind of retrenched, and it's just symptomatic of the more volatility that we knew was coming. The election will be this Tuesday, this coming week, and we may not know for a while, but there's all sorts of speculation as to what's going to happen. We know that the stocks that are kind of tied to what people believe are going to benefit, areas that benefit with the Biden presidency, did well because of the polling numbers, but it's quite the mixed bag. And so, we've seen less leadership from the technology stocks that we have during the entire summer. And good news is we're seeing increased breadth, even though it is painful to see a little bit of a retrenchment here on the S&P 500. At least it's more broadly felt. So it gives us a much deeper sense or deeper perspective on what's really going on the internals of the market. This is a chart that relates to earnings. I thought it was timely because we are basically heading towards the end of the third quarter reporting season. And so the blue bars here are the expected earnings growth rates year over year back at the end of September. And so the striped red and white bars are that same sentiment 1 month forward. So now that we've had the benefit of a lot of earnings reports, we have some, perhaps some fresh perspective on what's going to happen. And this is a compilation that was done by Scotiabank, but it relates to data that comes from FactSet. So this is a pretty broad representation of Wall Street and their opinions on S&P 500 earnings. And what you can see is there really not a whole lot of change. But there's a couple of aggregate numbers that I wanted to point out here. And so, third quarter, we know the earnings are going to be down big. Perhaps now they're going to be down a little bit less because we've had more beats. We've had better than expected earnings performance. Maybe that translates through to fourth quarter, which is also expected to be down. But then when you get into 2021, and particularly in that second quarter, so you look from left to right in that third set of data, first quarter of 2021, earnings are expected to be up about 13%. And if you get into the second quarter of 2021, they're expected to be up 44% year over year. And as I always like to say, earnings are sales are the mother's milk of earnings, and earnings, are basically the glue that holds price to earnings together and gives you the upside appreciation potential in the market. So all eyes will certainly be on earnings and earnings expectations as we head into the new year. And so if you look at the year over year on the right hand side, the key takeaway is that 2021 earnings right now the expectations have been tempered a little bit, but they're still looking up about 25% year over year. And if we do hit that, then obviously it gives us more upside potential in the market. One thing I wanted to mention here is that small caps recently have done better. This is a time series that goes back to 1994, and you can see historically small caps have had a positive influence on portfolio performance. And so recently we've taken small caps out, had taken small caps down in terms of their overall weight in the portfolio, but they're starting to act a little bit better again, and with the promise and the hope of improving economic conditions as we head into latter half of 2021 into 2022. There's a little bit better visibility on small caps and a little bit of price action. So that's something that we're taking a much deeper look at right here, right now here at BKA. Quick thought on metals. I've got really a small handful on metals. Gold has obviously been extremely strong. This chart from BCA seems to indicate that industrial metal prices are a little bit ahead of themselves relative to the commodity index that we see here. So I think we could see some volatility. And there's, as you can see, there's a traditional, historically, a fairly strong relationship there. So this deviation that we've seen here recently is apt to narrow at some point, and I suspect that metals prices might be a little choppy here near term. This is a technical scoring model for gold using the futures market. And so the way I read this is that, there's not a strong influence for gold to go much higher. And there's probably, an equal prospect of gold holding its own here, or maybe trading around a range. We've seen a lot of consolidation in gold trading lately, but this chart just indicates to me that we're not on the precipice per se of a huge breakout in gold. However, looking over the long term, I thought this chart was really interesting because this is looking at commodities relative to the S&P 500, and you can see that there's it ebbs and flows, and so this is basically a commodities related return over the S&P return. And you can see that right now there's huge underperformance. But again, this is not something that's happened this year. This has been in place for a long time, multiple years. But what does that say? Is there the potential? It seems to be. It would seem to me, if we're based on the scenario that we're looking at over the next several years, that we actually could see a bit of a commodity breakout relative to the index. So, which would obviously be beneficial to have diversification into commodities and other metals. And our last slide today, we'll just highlight almost like the playing cards here of world leaders that have contracted coronavirus. And as we all know, our own president recently caught this at the beginning of last month. Seems to have fared pretty well, but let's see, we all know how this virus is getting closer to us and people we know, family members. Some are very tragic stories of where people have passed away because of the coronavirus, but it's hitting all of us. But as you can see that, the virus knows no borders. It certainly knows no aristocracy or socioeconomic level. Based on that first slide that I showed you in the first series that showed the large spike in positive cases here recently and over the last month, that it just prompts us to continue to be vigilant, continue to do what we can do individually. It prompts us to listen to the experts, especially heading into the holiday season when it's getting colder. People are going to be inside more. There's going to be a strong desire to want to get together with families, and we know that the transmission rate within families is exceptionally high. So just implore all of you to be vigilant, be strong, and stay safe. We'll do it this week for Charts of the Week, and hope you've enjoyed it. Please feel free to reach out at the information you see below. Be safe and have a wonderful week.